craft check. Welcome to Book 101, Mr. Joshua. And as usual, can you please introduce more about yourself?
Yeah, what's up, everyone? I'm Josh, and I decided to start an investment firm called 369 Financial, where we love to educate people on the best ways to grow their wealth.
Yes, wealth, wealth, wealth. We want to earn billions, billions of money, people. So, Mr. Joshua, what are the most common financial challenges people face when managing their financial finances?
I mean, the most common are their mindset around money. So, a lot of people have a poor mindset, like POOR mindset around money. They don't know how to increase their income. And the final one is typically people get the money and then they just spend the money. So not knowing what to do with it when they get it.
They don't know how to invest it. So, how do you
Well, they don't even know that investing's an option. It's just like if you grow up in a
spend?
poor family and you start making some money, you want to start buying all those things that you couldn't buy before because you've been feel like you earn it and you want to be able to reward yourself. And then unfortunately, it becomes quite addictive buying nice things all the time.
Definitely, I totally agree. So, how do you determine the right balance between saving and spending in your budget?
Well, you have to think about having the end goal in mind. So it's like, what do you want your future to look like? Because if you're always focused on the present, which you can have a lot of fun right now, however, if you don't have any vision on what you want to be or what you want to do in the future, it's going to be really hard for you to delay your gratification in terms of buying that nice watch, taking that fancy vacation, buying that nice house versus having a mindset. It's like, well, if I save $1, this dollar could be worth $10 in the future.
Yes, for sure. What role does that play in financial instability and how it can be effectively managed?
Well, it is the Achilles heel that prevents a lot of people from meeting their full potential when it comes to building wealth is overspending, not putting money into assets, and eventually, if you're just a saver and you're too scared to invest, unfortunately, uh, people have created this thing called inflation. And eventually, the money that you have saved is going to not be able to allow you to purchase the same amount of items that you're purchasing today. So if you love cookies and $1 can buy one cookie, 5 years from now, that dollar is not going to be able to buy a full cookie because inflation is man made. However, it could be mastered by people.
Mastered and can be
Yeah.
saved for the future. Oh, we learned something today. People, so how do you assess whether an investment opportunity is worth pursuing?
Well, you have to look at there's two sides to a coin. And I read in the book The Down Doe Investor by I believe the author's Monish Pabrai. He's been regarded as the like Warren Buffett of India. As long as I pronounce his name right, I can't remember. However, in the book, I learned when you look at every investment opportunity, you want to look at it as heads I win, tails I don't lose much. And you want to have that sort of mindset. It's like if I put in $1, it could grow to $5, or I could lose 50 cents. And then you weigh the pros and cons, and then you determine how much you want to put into the investment. That's one very simple way of looking at it is figuring out what your scenarios are. Heads I win, tails I don't lose much is a very simple way of thinking about it.
Yes. So, how, what are the key factors to consider when planning for a long-term financial goals like retirement?
Well, you have to reverse engineer to determine what your strategy is going to be. So let's just say you're someone who's scared to invest. and you meet with someone and you're like, well, if you don't invest, you're never going to retire. And your goal is to retire, but you're too scared to invest. So now you're going to have to make a decision. Do you want to just do what you're comfortable with, which is not invest because you're too scared? Or are you going to get outside your comfort zone and do something that is outside your level of understanding and take a leap of faith and invest so that you could have the opportunity to retire? And a lot of people are not setting themselves up to be able to set themselves up to hit all of their goals because they're not taking enough risk with their investments, they're not saving much, or on the flip side, maybe your income isn't where it needs to be able to achieve everything that you want out of life.
In Never Broke Again, did you discuss what we are talking about right now?
You mean in
All
terms
the
of the
topics,
book or just like the mindset of never being broke again?
never the topics that we are talking about, did you discuss in Never Broke Again? Or what I'm asking.
Yeah, like so in the book, I've put in a lot of different chapters, such as I have it right in front of me here. Uh, I put in a lot of things, such as I put in this concept that I created called the 10 Commandments of Investing, and it's tips and tricks that I've learned from reading lots of different books, and it helps you determine, hey, is this a good business to buy right now? Is it fairly valued? Is it overvalued? One of the other items inside the 10 Commandments of Investing, which is a chapter inside the book, is that there's a common perception that people like to invest in dividend paying investments. However, in the book Common Stocks and Uncommon Profits by Philip Fisher, who, if you've ever heard of Ken Fisher, he's the father of Ken Fisher, who owns Fisher Investments. He actually writes in his book that dividends are the least reason to choose an investment. So there's a lot of things out there on social media and a lot of information that is being marketed to people that is probably not the best because everyone's situation is a little different. If you're Warren Buffett and your company's worth $1 trillion and
Why
you
not?
can put $250 million into an investment and get lots of dividends, I mean, that could be a good reason to do it. Unfortunately, most of us don't have that kind of money. So, in order to get to the level that we want to achieve, we have to put our money into investments that are going to grow at reasonable rates of return and get us the compound interest over time that I'm sure a lot of people have heard about.
Definitely. Very well said. Very well said, Mr. Joshua. So, can you please,
Thank you.
I think so can you please read the top five of the commandments?
The top 5 commandments? Yeah,
Yes.
actually have it right here. So, the beauty of having a book is you don't have to memorize everything.
Yes.
So, commandment number 1 is called about the Benjamin Graham calculator. So, Benjamin Graham is the person that essentially was Warren Buffett's mentor. Now, it's not the end all be all to determining whether an investment is a good business to purchase. However, it's a good starting point. So, essentially, what you can do is you can go to Google, type in Graham calculator. It's going to ask you for some data, such as the price of the company that's trading in the public markets, what are their earnings per share, and what is their expected growth rate. And you can compare that to something that is a guaranteed rate of return, such as a certificate of deposit or a US government bond, because those are considered riskless investments. So if you're going to take risk, you have to determine if that risk is worth the reward. So that's step one. So, for example, if you find that a company such as, let's just say there's a chip maker out there that has taken the main stage of late, a lot of people are hopping on the bandwagon because they're having a FOMO with it when it comes to investments. What you have to really look at is the current price of the investment that you can buy it at a good price? Is it undervalued or is it overvalued? because the price you pay for an investment matters. So I mean that's step one is look at a gram calculator, do some calculations. And then that leads me into the second commandment is the price of position. It's kind of like, do you really want to buy a car at full price, or do you want to attempt to negotiate a little bit to get the price down? Because it's better to buy a wonderful company at a fair price rather than a substantially okay company at an exceptional price, because it's good to have just reasonable returns that compound over time with as little uncertainty as possible, which with investing, there's always uncertainty. However, if you do your homework and you do the analysis and you follow some simple steps and you set rules for yourself, which the 10 commandments are essentially rules to follow. So if you set rules to follow for yourself and you don't veer from those rules, you'll set yourself up for more success, because the less mistakes that you make, which in investing, you're always going to make mistakes. No one's ever not lost money investing. I don't care if you're Warren Buffett. I don't care if you're Jimmy Buffett. You're going to make a mistake. So you have to accept that. And then that leads me to another commandment, which is don't be scared to sell at a loss. I go on I'll see on Reddit, people put in the comment section. You ever go on Reddit, Daniel?
Yes.
You'll see in the
Yes.
comment section is you don't lose until you sell. So, which is true. However, if a good opportunity comes up and you have your money in a taxable account, you could take the tax loss, write that off against your taxes. So you're showing the government, wherever you may live, that, hey, you lost money. And if you find a better opportunity, you can reallocate that capital. So on your taxes, you actually have a loss. However, in the future, you could have a substantial or gain when it comes to investing. So knowing how to take advantage of the tax code is definitely a game changer to help you level up your investment strategy. And a lot of people don't talk about that I really see on social media. Everyone's talking about like, oh, like invest in this insurance product or invest in this Roth IRA. And if you put $200 away every year for the next 30 years, you'll have $1.63 million. It's like, okay,
Wow.
well, is that enough for you to retire? I don't know. Um, in
For
addition to
sure.
that, another commandment is the fear and greed index, and that's definitely one that's important right now. And it's the disease that takes over the markets is when everything's going up, everyone's euphoric, everyone's happy. Whether you're investing in cryptocurrency, stock market, wherever it may be, when everything's going up, everyone gets so excited, and then everyone's like, "Oh, now I need to jump in." Uh, but one of the things that, if you ever read the Berkshire annual letters, is have you seen on the news that Berkshire Hathaway has like, I think they might have like $300 billion in cash right now,
Yes, I think.
and everyone's like, "Does he know something we don't?" Well, the thing is, on $300 billion, if they invest that into securities or government bonds that, let's just say for simplicity, are making 5%, for no risk, they're making 5% on $300 billion, which, let's see, on 300, 10% would be 30, half of that would be 15. So they're making like $15 billion in interest without taking any risk. So if they don't see anything they want to buy, they don't want to take the risk. And a lot of people get caught up in like, oh, I have to invest, I have to invest, I have to invest. Well, sometimes just stacking up some extra cash in your bank account could be the right move, especially if there's not any good investment opportunities, because there's always corrections in the market, there's always pullbacks, and those that have the capital are able to take advantage of those opportunities. So you have to always make sure that you're investing for the future, and at the same time you want to remain flexible in terms of being able to take advantage of when there's not euphoria in the stock market, but there's blood in the streets. And that's really when it gets exciting, is having a inverse relationship with the stock market. you actually want the stock market to go down. It makes every investor's job easier when the market goes down. When it's at the levels that it's at now, it's a little bit harder to find good opportunities because everything's up a lot.
Hmm.
And one of the commandments is when you think it's gone down on an investment, and Daniel, have you ever made like an investment? You're like, oh, like how much further down could it go?
Like every month.
Yeah. So I mean, you make an investment, and we've all made these mistakes. Is oh, like there's no way this company can go down more, and then it does. Well, on the other side of the equation, people will say, well, how much higher can the stock market go? They've been saying that for forever,
For a
and it
decade.
consistently goes up over time because
Century.
when the government prints money, people have to do things with that money. They have to spend it, save it, invest it. And if they continue to create more money, people are going to continue to invest it. And that's how the markets continue to grow. And that's what helps drive the global economy as people spend, people invest, and ultimately they're going to continue printing money because there's more people and the population is growing and you have to have more money for investment.
8 billion. Oh my goodness. Sooner or later, 9 billion. So, Mr. Joshua, thank you for those phenomenal. I hope people inspired to never broke again. So, how do inflation and interest rates affect personal and business financial decisions?
So inflation is essentially it's an equation. So if you have, let's just say, if you divided one by one, you would have one, right?
Yes.
But if I do one divided by two, now you're going to have 50% or 0.5 or one half. So essentially, the higher that inflation is, so inflation's that bottom number. So if inflation goes up, let's just say instead of 1 divided by 1, I do 1 divided by 5. That's going to be 0.2 or 20%. So the higher that inflation is, that reduces everyone's what's called real investment return. So essentially, if you're making 10% in your investments, but inflation's 10%, technically you didn't make anything. You're just keeping up with inflation. So when it comes to investing, you have to not only keep up with inflation at the bare minimum, you have to outpace inflation as fast as possible. So when you're looking at investing, and back in the, I think it was like in the 80s, people would make like more than 10% of their bank accounts. They're like, why should I invest? I'm making 10% in my bank account. Back at history, and you see how much people have made in investing versus just saving, it's pretty obvious. But in the present moment, people would say like, "Oh, why take that risk?" It's like, well, companies grow, you get the compound interest. Sometimes companies pay dividends, they split, they merge, and ultimately, if you're just keeping up with inflation, you're never going to get ahead. And that's why you have to invest, whether it's investing in your skills at work so you can get a promotion, whether it's investing extra capital in the markets. You have to be investing, whether it's in yourself or outside of that, because ultimately you have to make sure that your income and investments are always growing and outpacing inflation, not just keeping up with it.
Definitely. So, how can individuals or businesses prepare for economic downturns or financial crisis?
Yeah, so I mean, recessions are normal, and most people, when they you say recession, people think 2008, but that was a once in a 100-year event. And then you had also the global pandemic. That was typically like a once in a 100-year event. If you study history, I mean, these things happen. You know, people used to get polio all the time. Now, pretty much no one gets polio, or a very small amount of people get polio. Um, there was a Great Depression in the 1920s where people were literally jumping out of buildings
Yes,
because they were so
depression.
depressed.
Yeah.
Um, so, I mean, no one knows when an economic downturn is going to happen. However, if you're saving money and you have the assets to deploy, and if something happens, that gives you an opportunity to make a shift. So, a lot of people, when I worked at a big faceless organization, most people would want to invest middle risk, not aggressive, not conservative. Unfortunately, those folks in 2022, when interest rates rose at the fastest rate in a long time, their quote conservative investments did very poorly. So, what those folks could have done is sold their conservative investments. The stock market was down, the bonds were doing really crappy. Get out of those conservative bond investments and buy well established companies when the stock market was doing poorly, and they would have rebounded and done quite nicely. So it's knowing to make that shift and selling conservative investments at a loss and then shifting those into more growth oriented investments where you could take a loss. It's a little painful, but taking a loss on conservative investments is typically less painful than taking a loss on more growth oriented investments, especially when there's an economic downturn.
Very well said. Mr. Joshua, very well said. I was motivated to be the best of the best on my financial, uh, what do you call this? Financial support or financial whatever. So, Mr. Joshua, what motivates you to write Never Broke Again?
Well, it was a concept that me and some other people came up with, and it sounded catchy. Uh, there's a rapper called Never Broke Again, NBA YoungBoy, and I was like, well, Never Broke Again. Uh, Seems like a cool idea. So hopefully, I'm not breaking any rules, but I don't think I am.
No,
And
you're not.
basically, it's a wealth guide that I'm continuing to build on. I mean, I had an idea for a blog called the Millennial Slackers Guide. So I was attempting to write a blog to help educate millennials on various subjects such as like business, money, health, relationships. And that blog pretty much didn't go anywhere. But I wrote about, I want to say probably like close to 300 different blogs. And I was like, well, I need to start putting these together. And I want to put a book out there to help educate people on certain things. But unless you have a lot of social media influencers and followers, like you're not going to get a book deal. However, I figured, well, I can put it on Amazon, put myself out there,
Yes.
and I can continue to add to the book over time. And if it ends up helping people, great. If not, at least I went for it.
Yes, definitely. Congratulations for sharing your talents to the world. And are you interested to do a podcast like Financial 101 with me? Let's talk about everything under the sun. Or do you have a podcast already?
Yeah, I actually started a podcast called Unconventional Money Moves, where we
Yes.
have guests that have taken an unconventional approach to finding success in their lives. So, I mean, we've had authors,
That'll be
we've
awesome.
we've had people who plant trees using drones and AI. So it's been a lot of fun. We have a lot of interesting guests on, and I find it fun to learn from other people, see what they're seeing in the markets, what are they learning, and just having a normal conversation with them.
That'd be awesome. So, what would be your advice for those having a financial problem right now?
Ultimately, no one's going to save you, and no one cares about you as much as you do. So you have to figure out how you're going to get yourself out of the situation and ultimately determine what steps are required in order to make sure that this doesn't happen again. Otherwise, you're going to continue doing the same things over and over, and you're going to get caught in the merry-go-round of never making any progress because a merry-go-round is great for kids and parents because you put your kid on the merry-go-round, you know exactly where they're going to be, the same place you found them. And when it comes to investing in your financial future, you don't want to be on a merry-go-round. Uh, you hopefully want to be on a SpaceX heading to Mars and
Straight
beyond.
line. Straight line for sure. So, Mr. Joshua, can you please invite our listeners to support all your books?
Yeah, you can just go on your favorite social media platform and search Joshua Krafchick. I'll be on there. And if you want to learn more about 369 Financial, just Google 369 Financial or go to 369financial.com, and hope you find everything helpful.
Yes, people, let's support Mr. Joshua Krafchick because if you support him, more books to come, more empowerment to come. So, Mr. Joshua, thank you for your time.
Yeah, thanks for having me, Daniel. It was fun.
More to come, people. See you soon. Would you like to do another